Hello everyone, welcome back to the channel. In the previous video, we have discussed the theoretical part of partnership firm. So today in this video, we are going to discuss the accounting treatment in partnership firm, how to post the entries in accounts and how to distribute profits in different ways by using profit and loss appropriation account, by partners capital account. So today's video is going to be very important to clear your basics. In this video, we are going to read all the accounting treatments that are used by the partnership firms to prepare an accounts. So let's get started.
Before going to start practical aspects of this chapter, we need to understand the meaning of profit and loss appropriation account and why and how it is prepared. Profits are very important part of the business. So as its allocation, that is why the profit and loss appropriation account is an important part of the firm. Profit and loss appropriation account is necessary for the business, especially partnership firms, because they have to allocate and distribute the net of expenditures and incomes among the various partners. We'll start with its meaning. Profit and loss appropriation account is prepared for partnership firm. It is an extension of profit and loss account. It is used for allocation and distribution of net profit among the partners, reserve and dividends, and it is usually prepared after preparing profit and loss account. Let's see, in the 11th class, we used to prepare profit and loss account in this manner. What is in the profit and loss account? Profit and loss account is nominal in nature. Incomes are posted in credit side and expenses are posted in the debit side. Suppose our incomes are rupees 15 lakh and expenses are rupees 10 lakh. So we earned rupees 15 lakh and spent 10 lakh. We get profit of rupees 5 lakh. How do we calculate profits? When we subtract total expenses from total revenue and incomes, we find a difference. That difference is called profits. If our income is more than our expenses, then we call it profit and we write it in debit side. Or if our expenditures are more than our incomes, then we call it net loss and we write it in credit side. So now we have to see that what should we do with the profit and loss that we are making. So this was about class 11th. What happens now in the class 12th? You are studying partnership. So in the partnership, the partners would like to share this profit among themselves. When more than one person works together, so whatever profit they get, they share it among themselves. So this profit is to be distributed among partners and account is to be prepared to distribute this profit. We call it profit and loss appropriation account. See how we can distribute the profit. Now look how much profit we had left.
5 lakh.
If a partner has to pay interest on capital, so out of this profit we will allow the interest on capital to that partner. We will use this profit to pay interest on capital. If a person invests in business, then he is liable to get interest on capital. If a person invests in business, then he is liable to get interest on capital. Maybe a partner has to pay a specific salary. Sometimes some partners work in the firm in the same way that employees do and demands compensation in the exchange of his work in a firm. We will use this profit to pay any bonus, salary and commission to the partner for their services rendered to the firms. If any firm ever have a loss in the future, they can use that amount to cover that loss. That saving is called reserves. So if the company will have profits, then only they will be able to save that money. Even after this, if there is any money left, then what do we call? That money is called divisible profit. There are the things that we had to distribute it. Now we have to transfer it to an account. Let's see how to transfer these to an account, and that account is called profit and loss appropriation account. Let's see the format of profit and loss appropriation account. This account is prepared after preparing profit and loss account. It is prepared to distribute the profit and loss among the partners according to their profit sharing ratio and according to the partnership deed. And this account is prepared by partnership firms only. To prepare it, at first the balance of profit and loss account is transferred to this account. This account is credited with the amount of net profit and debited with the amount of net loss. To show how much is payable to partners and all the appropriations and expenses the firm has to be paid to the partners, like interest on capital, partners salary, partners fees, partners commission and bonus, etc., are recorded on the debit side of this account. Drawings are made by the partners and has to pay interest on drawings, and these drawings are income of the firm. To show how much interest on drawings charged on partners' drawings, interest on current account charged on debit balance of current account are recorded on the credit side of this account. So next is reserves. Reserves required for the future are created from this account. Hence, all the expenses and losses are credited and all the incomes and gains are debited in this account. So after recording all the entries, we will total the amount column on both sides. Finally, both the sides are totaled. If the total of the debit side means expenses are exceed that of the credit side, that is income, then the difference amount is shown on the of an account as loss transferred to partner's capital account. On the contrary, if the total of the credit side, that is incomes, are exceed that of the debit side, that is expenses are, then the difference amount is shown on the debit side of the account as profit transfer to partners capital accounts. However, if there is no written or oral agreement among the partners, the law prescribes that partners should share profit and losses equally. So this was the format of profit and loss appropriation account. Here are some certain points to remember while preparing profit and loss appropriation account. First is purpose. Purpose means what is our purpose, what is our objective of making this account, and why do we need to make it. So the purpose is to allow the adjustments to be made to the profit so that the final income can be divided among the partners as per the agreed terms and conditions. Overall, the firm uses it to show the allocation and distribution of net profit among the partners. Second is creators, means that person who invents, produce or make things, anything. Hence in the partnership, creators means who creates or maintain an accounts. A partnership form of business organizations creates such kind of special account. Moreover, the partnership deed plays a very important role in deciding the various rates and amounts. So it is prepared only by partnership firm. The partnership firm is the creator of this account. Third is time of creation. Time of creation means the time in which firms maintain their accounts. So this account is prepared at the end of the year. So like the final account, this account is also created at the end of the financial year, which is made on the 31st March of every accounting year. So similarly, profit and loss appropriation account is also prepared at the end of the year. Next is features of profit and loss appropriation account. First is it is just prepared after the profit and loss account. Thus, it is an extension of profit and loss account. Second is it is prepared only by partnership firm. Appropriation accounts are mainly prepared by partnership firms because they help to allocate the net of expenditures and income among the various partners and showing how the profits of the firms are allocated or distributed to the shareholders or to increase reserves indicated in the balance sheet. Third is it is a nominal account. Why it is called a nominal account? Nominal account is a general ledger account pertaining to all incomes, expenses, losses and gains. Means in this account all incomes and expenses are recorded in this account, same as profit and loss account. So this account has a nominal account nature. Fourth is it shows the appropriation of the net profit and the loss for the accounting period among the partners. It is prepared for the purpose of adjustment the transactions relating to amount due to and the amount due from the partners. Thus, it helps to allocate the net profit among the various partners. Last and fifth, entries in these accounts are made giving effect to the partnership deed and the Indian Partnership Act 1932. The purpose is to allow the adjustment to be made to the profit so that the final income can be divided among the partners as per the agreed terms. Means profit and losses made by the business are shared among the partners based on their initial contribution percentage unless agreed otherwise and set out in the partnership agreement. Here is one important note to keep it in mind: items that are not considered as appropriation. There are few items that are concerned with the partners but are not recorded in profit and loss appropriation account, rather are considered as charge against profit. Such items are recorded as expenses in profit and loss account and charges even if the firm incur losses. Such items are interest on loan of partners, rent to partners on their property, and managers' commissions. Next is partners' capital accounts. A partnership firm has more than one partners and capital account is maintained for each partner separately. It is so because each partner has separate transaction with the firm. Suppose there are two partners, Mohit and Rajit. There will be Mohit's capital account and Rajit's capital account. Hence, there shall be the two capital accounts on each for Mohit and Rajit. So, a capital account is a general ledger account which shows some of the special transactions like proprietor's investment in his own business, the aggregate amount of earning, expenses of companies, etc. There are many more transactions which affect the capital like interest on capital, interest on drawings, salaries, commission, etc. These values are put in profit and loss appropriation account at the same time credited or debited to their respective capital accounts. But there are two conditions to be noted in the capital accounts. Some partners want their capital to be always the same. Do not change. Some people want their capital to be fixed all the time. Some people want their capital keeps increasing or decreasing. They do not mind that is fluctuating capital. So there are two methods by which the capital account of partner can be maintained. These are fixed capital account method and second is the fluctuating capital account method. First one is fixed. Let's start with first method, fixed capital account method. Capital is in nature that it increases when it is debited, it decreases, and when it is credited, it increases. Under fixed capital account method, two accounts are maintained for each partner. First one is the partner's capital account, second is the partner's current account. Let's see the first method under fixed capital account method, partner's capital account. First one is partner's capital account. The firm opens the account in the name of fixed capital account. Initial investment will appear on the credit side as the starting entry. In fixed capital account method, in the partner's capital account, only these are recorded: capital invested by each partners and the additional capital introduced by any partners, capital permanently withdrawn by any partners. This makes the balance in the capital account is fixed year after year. That is the reason why this method is called fixed capital account method. Here is partners capital account format under fixed capital account method. In this method, we study how the entries are passed in this account. Partners capital account is credited with first it start with the buy balance drawdown, that is called opening balance. After this, what are the things that will increase the capital? So if more money is invested, then our capital will increase. it is written with by bank as additional capital or introducing capital. So all the expenses of the firm, that will be the income of the partners. So the way money is coming to us, in the same way money can go to us many ways. So the way we invest money, we can withdraw the money in the same way, right? Partners capital account is debited with to bank as capital withdrawal according to the partners. After recording all the entries, we have to calculate balance. How to find the balance? We When we minus the credit side from the debit side, we will get the balance, and so we will write it down on the debit side and with the balance. So we will write it down on the debit side with balance carried down, that is the closing balance. So the debit balance capital gets reduced and the capital of the credit side is increased. So this is how to partners capital account is made. Next is partners current account. All items like share of profit or share of loss, interest on capital, partner's salary, partner's commission, partner's bonus, partner's drawings against profit, interest on drawing, etc. are recorded in a separate account, and this account is called partner's current account. Transactions relating to capital are not recorded in this account. Capital introduced by the partner, additional capital introduced by the partner, and drawing against capital, these are recorded in the partner's capital account. Let's see the format. Partner's current account is credited with, firstly, if any current balance is there, then we'll start with the same entry. Then we'll start with the entry by balance brought down on credit side according to the partners. If there is no credit balance, then leave it blank. All the other items like interest on capital, partner's salary, partner's commission, partner's bonus, share of general reserves, and share of profit. So on the credit side, we write all those things from which we have to get money. So it was all that is coming. Next is partner's current account is debited with drawing against profits, interest on drawings, share of losses. So after recording all the transaction, we will calculate the balance same as partner's capital account. In fixed capital method, the partner's capital account will always show a credit balance. The partner's current account may show a debit or credit balance, right? Here one note you have to keep it in. Here is one important note. It should be kept in mind that partners capital account are always shown in the liabilities side of balance sheet. If the credit balance in current account is shown in the liabilities side and the debit balance in the asset side of the balance sheet. Hence, by preparing this account, we can let the main capital of the business fixed, as a result of which there is no fluctuation at all. Hence, the firm will be able to find out the exact reasons behind the change. Now we have the next method is fluctuating capital account method. Firstly, fluctuate means anything having unpredictable ups and downs. Hence, under this method, the capital of each partner keeps on changing from time to time. In a firm, there is a single account under the name capital which shows all the necessary information about the different transactions related to the capital. It mostly starts with a credit amount of the capital invested by the partner in the initial time of the business. Under the fluctuating capital method, only one account, that is capital account, is maintained for each partner. But in the fixed capital account, we need to maintain two accounts, right? All the adjustments such as share of profit and loss, interest on capital, drawings, interest on drawings, salary, commission, etc. are recorded directly in the capital account of the partners. This makes the balance in the capital account to fluctuate from time to time. That's the reason why this method is called fluctuating capital method. All the adjustments leading to the all the adjustments leading to a decrease in the capital are shown on the debit side of capital account, like drawings against capital, drawings against profit, whatever. Interest on drawings, share of loss comes on the debit side of the capital account, and all the adjustment leading to an increase in the capital such as interest on capital, partner's salary, commission, bonus, share of general reserves, and share of profits are shown on the credit side. Again, after recording all the items, we will find a balance, same as fixed capital method, same as the current account method. When we minus the credit side from the debit side, we will get the balance, and so we will write it down on the debit side with the balance carried down. This is the closing balance. Again, you have to keep in mind one note: in the absence of any instruction or information, it is assumed that fluctuating capital is followed for maintain the partner's capital account. So this was the fluctuating capital method account. This was the pro forma of partner's capital account prepared under the fluctuating capital method, right? So here was the profit and loss appropriation account and partners capital account under both methods, fixed capital method and fluctuating capital method.